Imagine a bunch of roommates. Some save every penny, others, not so much. But one day, they all decide to share a credit card. Risky? Maybe. But it could also be smart, if they trust each other enough. Now zoom out. This isn't about roommates. It's about countries. And Europe is starting to think, maybe it's time to share. Today, we're diving into why the European Union is considering creating a massive joint debt market, Eurobonds, and why this could shake up the world's financial system, including what it means for the United States. What are reserve assets, and why does America dominate? For decades, the safest place on Earth to park your money hasn't been a bank or a vault. It's been US Treasury bonds. Countries like Japan, China, Germany, and Saudi Arabia all buy them. A lot of them. Because they're reliable, easy to trade, and backed by the US dollar, the world's top reserve currency. This trust gives the US huge advantages. It can borrow money more cheaply than almost anyone else. It can run large deficits without immediate punishment. And it can project economic power because everyone needs dollars. It's a financial superpower that supports its military, global influence, and even allows it to sanction countries by cutting them off from the dollar system. In short, treasuries are America's golden goose. What's changing under Trump? But recently cracks have appeared. Under Donald Trump, the US started looking less trustworthy. Big tariffs slowed economic growth. Deficits ballooned, 6% of GDP and rising. And the Federal Reserve? Trump pressured it to cut interest rates and is expected to replace its chair with someone more politically loyal. That scares global investors. Because if inflation rises or the Fed loses credibility, Treasury bonds lose value. That's risky for the countries holding trillions of dollars in US debt. Some started asking, is there an alternative? What are Eurobonds and why now? Enter Eurobonds. A shared debt instrument across the European Union. Think of it like all 20 Eurozone countries co-signing the same loan. They've tried this before, during the Eurozone crisis, but northern countries like Germany said no. They didn't want to guarantee the debts of countries like Greece or Italy. But now, the reason is different. Europe isn't trying to bail anyone out. It wants to build a real rival to the US Treasury market. They've already started. The EU has issued around £300 billion in joint debt for pandemic recovery. More is coming for defence and energy programmes. If scaled up, these Eurobonds could offer global investors a new safe asset. What would the US lose and Europe gain? If Eurobonds take off, here's what could happen. The United States would lose cheap borrowing costs, some of the dollar's dominance, and its monopoly on the world's safest debt. That means less economic leverage. Sanctions could become less effective. And the US might finally face pressure to get its fiscal house in order. Europe would gain cheaper financing for infrastructure, energy and defense, more influence in global markets, and a cushion against US political chaos. Because let's face it, the 2025s haven't been the most stable years for American policy. This isn't going to happen overnight. Eurobonds still face resistance inside the EU, and the US Treasury market isn't collapsing anytime soon. But the fact that Europe is even trying to compete and building real tools to do it, that's historic. So next time someone says economics is boring, just remind them, it's also about power, trust, and who holds the world's wallet. If you found this breakdown helpful, give the video a thumbs up and subscribe to the channel. And for more deep analysis on European politics, global finance, and transatlantic strategy, visit westernrelations.com.